Credit is arguably the most important part of our economy. Credit increases the purchasing power of the consumer, which leads to increased consumption, therefore faster economic growth. When credit availability is expanding, businesses can borrow and invest more. Increased consumption and investments increase income and profits, which create jobs. Alternatively, when credit availability shrinks, so does the economy, as witnessed during the financial crisis of 2008. The credit markets froze, bringing the global financial system to the brink of collapse. When we think of credit, most often we think of point-of-sale transactions, the financing of automobiles and homes, business loans, and other extensions of credit provided by banks or financial institutions. But credit is also widely used in commercial transactions between businesses. During the economic downturn, banks and traditional lending institutions tightened their belts and lent fewer dollars to businesses. Many businesses turned to trade credit as an alternative means of short-term financing. Trade credit, also known as supplier financing, is a business-to-business agreement in which a supplier allows their customer to purchase goods on account, giving the customer some predetermined amount of time to pay for the goods, typically 30 days from the date of purchase. Ideally, the customer can produce and sell the inventory before the supplier's bill comes due. This form of financing has many benefits for both the supplier and the customer. For the supplier, extending the line of credit means that steady flows of revenue are created. For the customer, the establishment of credit terms makes it possible to order what is needed now and pay for it incrementally while earning a return from the use of the items ordered. Trade credit is essentially businesses working together to make efficient use of capital. In many markets, suppliers must offer some form of credit to their customers to be competitive in their markets. Since these trade agreements typically do not involve a bank or a third party, the supplier must act as its own bank. Suppliers usually rely on internal credit and accounts receivable department that work in conjunction with the sales department to make sure that purchases on credit are going to credit-worthy customers. Various industries use various specialized forms of trade credit. This course will provide a general overview of the standard credit and accounts receivable practices commonly used by suppliers. In the next module, we will discuss the credit department and its operations.